So welcome everyone to the Distilled Spirits Council Ask the Experts webinar series. I'm Amy Carter. I'm the Vice President of Member Services and Business Development at the Distilled Spirits Council, also known as DISCUS. I want to make everyone aware that we are recording this webinar so that it will be available later on the public DISCUS YouTube channel. And then I do want to say also, before I welcome our guest speaker, Thomas Paulson of Placer AI, I just want to read our antitrust policy statement that we read at the beginning of every Discus event. Oh, there we go. Okay, so I just want to remind everyone to refrain from discussing or exchanging information relating to pricing, relating to marketing or sales plans. Don't discuss anything related to costs or confidential plans regarding output or production. We should not be discussing boycotting another company. We shouldn't be discussing recruiting or hiring each other's employees or salaries or wages or benefits or any other competitively sensitive or proprietary business information. So that is something we say at the beginning of all of the Discus meetings. And with that, I just want to, for the folks who don't know Discus, we are the leading voice and advocate for the distilled spirits industry writ large, and of course for our members. We also provide a wealth of education, resources, services, and networking opportunities for our member companies. This webinar is part of a benefit of membership, but also we try to share, we like to ask our members to share their expertise and insights with the broader industry. And so we hope to bring relevant discussions to you all. And if you ever have any suggestions for discussion topics, please feel free to email us at membership@distilledspiritscouncil.org. Our speaker today is Thomas Paulson. He's the Director of Research at Placer AI. And Thomas has been with us a couple of times this year, but this time he's going to share some data on consumer trends in the on and off premises space. So Thomas and I will have a conversation for about 30 minutes. And I want to encourage folks to ask questions throughout. So it is more of a conversation. You can either use the, raise your hand icon at the top of your screen or put your question in the chat. And either myself or Caleb Ross, who is the Director of Member Services, who works with me on Discus membership, or Luis will field the questions. But we'll also leave specific time at the end for additional questions. And then, I also want to say, if you want to connect directly with Thomas afterwards, feel free to make that known in the chat, and we'll be sure to connect you all via email. Or you can always email the membership if you'd like, and then we can connect you that way as well. So Thomas, welcome back.
Thank you. All right, so what I got for you folks today,
There we go.
which is really consumer spending that we've seen over the summer and how that kind of set up in terms of expectations for the second half. The main takeaways of the presentation, just really from a macro consumer perspective, is that essentials-based retail, and I kind of consider the spirits and the BevAlc industry to be somewhat an essentials-based category. So that essentials-based retail has had a more challenging year as incremental budgetary pressures have pressured the less affluent. And so we've been seeing a more pronounced, what I call K-shaped economy. But the more affluent have also become increasingly frustrated by absolute price levels as well. And I think in July, we've seen slower business for a lot of consumer categories. And I kind of tie that up as that consumers are fed up with price levels, and it's leading to a buyer strike. And there's that strike has, plus depleted excess savings, has resulted in a step down in consumer activity in July. Now, consumers are seeking out absolutely lower price points, and where they find them, they are buying. So just as fate would have it, Walmart reported results today, and they had solid comps, and their highest growing consumer category is what I call the more affluent. So that I kind of peg at 100,000 and above in household income. Because of this issue where households are fed up with absolute price levels, we're seeing really pronounced loyalty discounts being offered in the grocery channel. Lots of hotly promoted items across retail, which is leading to distortions where we're seeing more traffic, but less average ticket. And so folks are shopping multiple different banners to cherry pick those promotions to seek out the best value from any given grocer. Loyalty offerings in terms of app from your grocers or your mass retailer are really becoming accentuated, and that's distorting spending, et cetera. So all of that, in my view, is leading to a deflation in goods and in just both in goods deflation, both in goods and in discretionary services. That's likely to give the Fed greater confidence that confidence is well on its way to a 2% target, and that would allow them to cut rates as we move to the second half. That becomes important when we think about that lower income consumer, where I'll point out just the high rate of interest expenditures that less affluent households are facing this year. When we look at this category, the spirits category, in terms of the government data, distributor inventories remain too high, and that's likely to remain a headwind in the second half. And everybody wants to know about how to think about the presidential elections. Well, our data goes back to 2017. It doesn't do 16, so obviously 16 was the last time you had quote unquote a normal presidential election. But in my 20 plus years as an economist and as a industry analyst and student of the consumer, generally I think based upon that history that the Thanksgiving and holidays should prevail again this year. And for those who remember last year, Thanksgiving and holidays were a good period as well. So what is Placer? So we've done a numerous presentations on Placer to the Discus audience. So I'm going to skip over this section pretty quickly. But how I describe our data is we're contextualized geolocation data. We have a panel of millions of cell phones that we see because there's an app on the phone where somebody opts in to have their location tracked. They get a benefit from that app. So think Google Maps, Apple Maps, Fitbit, hundreds of different apps where I want my location tracked because I get a benefit from that. That's why I'm using that app. And so we partner with those apps to get the signal. So we see, that consumer activity around the United States. And then what we've done is we've added context to it. So what I'm showing you here in terms of context is I've set up a geofence for the Jack Daniel's distillery. And so that looks in this bottom panel, this is what that looks like on, Google Maps is what it would look like above, or if you were there in person, it'd be in that picture. And so when someone comes into Jack Daniel's distillery and stays for 30 minutes, I count that as a visit. And so we are measuring the visits to that distillery, and we can see them on a daily time of day, if you want weekly, monthly. And so this looks over the last year, I guess, through April, that they had 166,000 visits from 153,000 visitors, and those visitors stayed on an average of about an hour. And then we can also look at other kind of ways of geofencing locations. So this is 2nd Street in Long Beach. And what I'm trying to understand in this view is the nightlife activity to 2nd Street. So I'm looking Thursday, Friday, Saturday night, 6 to midnight for people who stayed for an hour. And we can see in 2019 that over the summer months, there were 126,000 visitors and 137. And as we really, celebrated coming out of the pandemic, 151. And so that kind of dynamic led 2023 to be a very successful year for on-prem.
And Thomas, if
Go
I
ahead.
can just say something, because I know you're going to do this at a very high
Yeah.
level and very quickly. All these slides will be included in the recording that will be on the Discus YouTube channel. So if people want to learn more about the type of data Placer captures, it'll be there, and people can follow up.
All right, thank you. Um, and so you could actually do this for 22 other districts around the United States. And I selected 22 districts that are more local than, destination visitors like Vegas or whatever. So things like East Williamsburg, Fulton Market in Chicago, Deep Ellum in Dallas. And so if you put all of these together, you can create what I call our nightlife index. So the green here is all of those districts combined, Thursday, Friday, Saturday night, 6 to midnight, 1 hour stay. And then red is 2024. Now, 2023, broadly, if you looked at versus pre-pandemic, was a good year. And then 2024, not such an ebullient year of going out in the town and having fun. I call 2023 the year of peak more fun. And so we started soft. Obviously this is dry January, so not an important month for the category, but weather was problematic. And then as we've moved through May, June, we got a little bit of pop here. The 4th of July and the week prior to the 4th of July were pretty strong weeks. But overall, nightlife is down about 2%. And then, within that 2%, perhaps people are sipping their cocktail for longer, or they are not using, top shelf, they're using rail. So you could definitely have negative mix and less volume on the overall traffic. But, at least, we're bouncing around. People are engaging with the category. There can be consumer behavior differences between the 2 years within that behavior. But, I'd say we're down from last year's equivalent year, but we're not, way down, just softer. And then, there are some districts that are up and there are other districts that are down. So Deep Ellum is in Dallas has, had a really soft year. And then, I would imagine this summer's weather, also
Mm.
resulting in a depression in activity as we kind of moved into the real heat domes in early June and late July. Whereas the Fulton market and has had a really great year. So I guess my little joke there on the right is lots of risky business in Chicago in 2024. Um, if we look at Vegas, so this is overall visitation to Vegas, and in 2023, the blue line, you can see it generally below the orange line, and the bars being year-on-year decline. So we're down in visits to the Strip. This is looking just at the Strip, about 4 or 5%. And I'm looking for people who stayed for over an hour within the 6 to midnight window. 4th of July was, a good period of time, and in terms of reversing that year-on-year decline. This is everyone. So if we move to this next slide, here I'm looking at just households that have over 125,000 in income. And the way I divine that we're looking at that is where a cell phone goes at night on a repeated basis, I tie to its census block. And then U.S.
Mm.
Census records, number of people in that census block, their income, their family status, their home value, their educational attainment, et cetera. So we take all of that data and spread it across all the signals that we're seeing to create a profile of who's like visiting the New York or the Las Vegas Strip in this case, or if we want to look at only those with 125,000 or higher in household income in terms of the census estimates. And we can see that 2024 is generally above 2023. And then particularly when Vegas got really hot, a lot of people went to go escape into the air conditioning of the casinos during that period of time. So that was a pretty, I guess not to be too cute, pretty hot time for Vegas. And the operators, the that have high-end properties, whether that be MGM, which owns Bellagio, or Las Vegas, or sorry, Wynn Resorts, which is also owns Encore, they are very constructive around Vegas. On the other hand, and what they see on the other hand, like MGM is talking about their value properties, something like Luxor or New York, those have been softer. So, favorably, a lot of this the spirits category is by the more affluent, but when we look at all of our trends, there is definitely a weight that's happening in terms of the broader consumer because of the less affluent. And this gets to looking at those two period times in terms of two high-end resorts or casinos in Vegas for that June through July period. Just those above 125,000 income. I have visitors. I have their average dwell time or visits average dwell time and multiply those so I can see time spent in Bellagio was up 41%. Time spent in the Wynn resorts is up 20%. Obviously, time spent, can be directly related to either, the amount of gaming or the amount of fun that's being had within these properties. This is looking at a different slice. This is looking at Kentucky distilleries. And so in 19, you see there, and the Kentucky distilleries have, had a really great run year after year. And 24, is up generally off of 23, but you can see that there's a softening that's happening as we move through July. And broadly speaking, we are seeing a softening in consumer activity, both on-prem and then within categories off-prem as well. So what's going on with the consumer? So this is a slide I've shown before, but before we go to what's going on with the consumer, Amy, are we okay, or any
Yeah,
questions
we're
there?
okay, but yeah, I was going to say shift to the consumer because I know you're going to talk about
Yep.
inflation, sort of the
Yep.
trends through the midsummer, the news cycle, and the impact of the Olympics, and then what that means. Oh, and also I think you're going to focus a little bit on some of how other categories in the broader economy are sort of doing, which I think
Yeah.
is very helpful, just context overall when we see this sort of economic, what I call continued economic uncertainty. I don't know what you actually call it. But yeah, that would be great to shift
I
gears to
call
the
it muddled.
consumer
I call it
trends.
muddled.
Muddled. Okay, muddled. I like that. Muddled as
Uh,
in like a muddled cocktail.
yeah, muddled. But this is to me the most important kind of macro consumer insight on this slide, which I've shown to this audience before. It's looking at grocery prices, or really for both food and bev, but obviously mainly that's food, versus currently versus pre-pandemic. And people go to the grocery store and buy groceries 2 or 3 times a week, so it becomes highly visible. And what happened really is, and we all know it, grocery prices got incredibly expensive. So if we look at where grocery prices and spending were through Q1, you're up 34% in dollars, but only up 8% in actual calories or spending. So really crazy amounts of price inflation in an essentials category, which was really destructive and detrimental to consumer confidence in 23, and has been continued pain point as we've been dealing with 24, as what I call essential services, which is really interest expense and insurance, became another compounding inflationary pressure on households. And just this inflation in grocery that was ate up really 290 billion of consumer discretionary spending. That's just a massive number. And that's not something that most retail businesses had ever experienced. Most consumers, right, for the most, broadly speaking, never had seen this level of inflation, and it was freak out, and people's food insecurity, elevated. And in an effort for households to get the calories that they need, they began to shop multiple banners, multiple grocers, and mass discount stores, which is primarily Target and Costco. You began to offer more coupons and more promotions. And so what happened, and then just because of the high level of prices, people, less affluent households had to stretch out their paycheck and to make their cash flow for the month. So this led to kind of what I call shopping multiple banners, trip fragmentation. In contrast, during the pandemic, we had trip consolidation, and basket size went down as I'm buying just fewer items per basket, and I'm looking for lower, promoted items that are going in that basket. And so a pretty good decline um, through the summer and became more pronounced even in July. And one way of looking at part of that trip consolidation is consumers going into discount and value brands. So Aldi for May through July, visitors are up 20% plus. So those who visited an Aldi just once, or at least once, was up 22%. Those who visited and I think actually that's just once was 22%, twice was 22, three times 27%, and 31% for over three times in the quarter, so over once per month. And this is Aldi building new households, and then building wallet share of those households as time goes on. And this share shift to value and discount is really pronounced in conventional grocery and is affecting most national brands. And I would expect this the spirits category and the as well. And so when we so that's grocery. So this is looking June through July for a multitude of categories. So liquor stores is the dotted red line. After the fourth, you can see there's a tip down there. Dollar stores, a little bit of tip down. Home improvement, a little tip down. Home Depot just reported results actually, and for their month of July, they were down 5% in comp store sales. Sporting goods really soft. And so, I just say overall, July is a little bit touch slower, from June. June was better than May. May was better than April. Then July is softer again. And then this is looking at restaurants. So restaurants overall is the red, and this is both sit down and fast casual and QSR. So restaurants overall red. You can see kind of July through the first 3 weeks of July softer, then somewhat of a bounce back at the end of July. If we focused in on Florida and Texas, where we had either hurricanes or severe weather, you can see that created a deficit in those weeks, and those are really
Thomas,
big. Yeah,
Thomas,
yeah.
do you have any idea but why there was that sort of little bump up towards the end of July?
Well, probably because people kind of were
Or
stuck of
what?
being stuck. People were sick of being stuck at home after
Oh,
these
okay.
severe weathers, and so I think there's a little bit of bounce back
Okay.
from that perspective. So I think there's some recovery just because of better weather, and so we'll
But then
see
a
what
sharp
happens.
downturn in the beginning of August, it looks like. Yeah.
Yeah, yeah. Uh, well, this is May, June, July,
Okay.
and um, and then this is looking, and I'm just not picking on Total Wine here. I'm just picking Total Wine because they have a national footprint. So you can see, pretty consistent growth week on week, with the exception that July 4th was a pretty festive week. And I've written about that. I read a weekly, and I've written
And I
about
presume
that.
that's typical, right? For a year, July
Well,
4th, that
this would be
going into it.
normalized. So this would be,
Okay.
4th of July versus 4th of July. So I think just broadly speaking, we had a really good 4th of July. And what we've seen over the last year and a half, 2 years is, the consumer celebrates holidays. So, that's like last year, Thanksgiving and Christmas were, a very festive period after a pretty big slump ahead of Thanksgiving, and then we went, soft again, and people came out for Easter and spring to a degree. And so, it's this whole seasonality to consumer spending where events and holidays become more uh, lively, if you will,
Mhm.
or more elevated, where the shoulder periods become broader and deeper in terms of their troughs.
Got it. Okay.
And then this again, since I picked on Total Wine or showed Total Wine here before, I'm showing, Total Wine, and what our data can do is we can, slice things by, brand, but also by state and by category. So here we can see that, Florida has been softer for Total Wine. Part of that's weather, part of it's Florida is just a softer market for the consumer. And if we look at Florida for Total Wine. We can see, Orlando a bit more stable. That Miami has become quite soft in June and July. Uh, and then, Tampa kind of plus or minus. And I think the weather was,
Okay.
part of the July story there. Um, so, other categories that are citing a weaker year include auto part retail, discretionary dollar stores, thrift stores, home improvement and home related goods, cosmetics, beauty, QSR, airlines, theme parks, hotel operators, regional casinos, branded packaged food for the reasons I
And
chatted.
Thomas, can you remind everybody what QSR is since I had to ask you
Quick,
that same
yeah,
question?
quick service restaurants. So it's the Burger Kings, McDonald's,
Yeah.
those type of operators, Chipotle.
And do you know, are those categories seeing like weaker years similar to beverage alcohol or greater
I mean,
or lower?
everybody's got their. I call it, in the spirits category, they call it the COVID super cycle, and they're lapping the COVID. So everybody kind of has their somewhat their. So if you do like airlines, theme parks, I mean, they had a great year in 23, and they
Yeah.
really set up too much capacity or had expectations for another great 2024, and that was just a really difficult year to lap. In the same way for the
Hmm.
spirits category, in 23, it was 22 and 21 were very difficult periods to lap.
Yeah.
But
Okay.
this is what I'm just saying, though, and when I bring the point of this slide is it's not, it's the brands that I highlighted earlier, but it's the spirits category, but there's a lot of other categories that are here. So that's why I call it, more of a macro dynamic. Um, this is the New York Fed's data, and this kind of again points to, where the weakness is at, which is the less affluent, and you can see job separations expectations for those with less than 50,000, is, been elevating in 24, and earnings growth uncertainty, seeing elevated on the right hand side in 2024. And one thing, and again, the spirits category is, it weights into those that are older than 55 and those that have more than, I think it's 100,000 in household income. I did a report a while ago. I can't remember that right off the top of my head. That's like 2/3 of the value.
Hmm.
But the to just kind of level set, if I were to say, the less affluent, so more affluent, less affluent, split the middle in the country, and you mean weight that less affluent bucket, I mean, it's 30,000 in household income. So that's, this 50,000 is in that bucket, and you can see that's a fair amount of uncertainty as we kind of went through 24 on the right hand side. So the July slowdown. So these are the culprits that have been suggested, and some of them, are just transitory. Some of them, less
Yeah.
transitory. But I think I'm hopefully leading everybody at the end of the day here a discussion with a little bit of a hope as we kind of end the year and go into next year. But people cited, just the news cycle around the presidential election, the Biden shuffle, the assassination attempt, Paris Olympics stealing attention. Now, I just saw these data stats yesterday. 30 million Americans watched the Olympics every day the last 2 weeks. That's just a really big number, right? So
I was
I
one of
don't know,
them.
maybe people were having cocktails at home while watching the Olympics, but I think, that's a pretty big number. So I
Okay.
think, the
Well, it's
Olympics,
really interesting. You all don't do global data, do you? Because it would have been
no,
interesting to compare what the Paris foot traffic was, because I'm one of those people that watched a lot of the Olympics.
yeah,
But I know obviously Paris has France has a different culture, and they have a cafe culture, and they talked about how, many people would just go sit in cafes and bars and, watch the Olympics, not in their home,
yeah,
but in a public space,
yeah, and
or restaurant or bar or whatever. So it'd
yeah,
be
that's a
interesting to
cultural
get that kind
difference.
of data.
Yeah, that's a cultural difference. So maybe a boost to them, which is what happens during, the World Cup. It's a big boost in that market.
Yeah.
Where in the U.S., most people are at home. But anyhow, I touched on extreme weather patterns, and what we've seen for weather this summer. I mean, these are extreme weather events and big hurricanes, and those are going to be disruptive. The fourth one, although I want to highlight here, it's a further depletion in the savings and spending power that's being drained by higher interest expense, as well as higher inflation on essential services, which is like insurance. So, I understand that not everybody owns a home. I was surprised to see just my recent insurance bill that renewal
Mm.
that I got this last week, which was a 50% increase. It was a big
Wow.
dollar. And my auto insurance has doubled over the last 2 years, et cetera. And as time passes, uh, these inflationary pressures, and they're both really inflation, are creeping higher from lower income households. And so, in
Yeah,
other words,
Thomas, I want to say, so we're running short of time, but I
okay,
know that we have a whole lot to cover. So I wonder if there are things that maybe we can um, just do very high level the next couple slides, but then really then talk about the off-premises consumption.
yep,
So I know you have a
yep,
couple slides on that, and then
okay. Yeah, sorry, I'm having a hard time keeping track of my time. Give me just one second.
that's all right. That's my
So,
job.
Um, so this is just looking at foot traffic for a couple different brands. Uh, uh, Over the month of June and July. And, you can see there that, at least, for the Paris Olympics, that, there seems to be a softening that happened. I'm blanking out the 4th of July. That just created these big distortions in year-on-year comparison issues. Um, this is looking at excess savings. So this is, the monies everybody got in terms of stimulus during 21. And then a lot of people put them in their bank accounts, and then they've been spending through that. And really here, March, you can see that we've kind of gone below zero. And so I think this is what's driving this year to be softer broadly for the consumer, that the consumer from that excess savings is tapped out. This is
Okay.
looking at delinquencies on credit cards by age of credit card owners, so younger consumers, millennials, et cetera, up for all different age brackets. Rising delinquencies means that credit card providers are cutting credit and cutting credit or limiting credit to those who are deemed less credit worthy. And that's affecting consumer expenditures because there's not that same level of liquidity and
Mm.
access to credit or savings that were there. So that's why this year is being more difficult than last year.
Well, then you also
And
add in
then,
the inflationary pressures too, would you say?
yeah,
Okay.
it's
Yeah.
compounding issues. So this is another big one, which is looking at revolving interest expense
Mm.
versus discretionary spending. And what I show here is, debt outstanding kind of flat-ish as we move through quarters, because this is banks tightening credit, so we're not able to grow credit. This is interest rates. In 19, we were 14.9 on average rate on a revolving debt. Now we're up to
Oh.
21.5. That took
Ooh.
this annualized expense 289 billion versus 162, so really a doubling of that. And this is looking at discretionary PCE. Part of that would be going in the spirits category, and the way I'm defining it here, so that was 4.6% was interest expense. Now that's up 6%. But if you look at less affluent households, you're going to have less discretionary spending. You're going to
Mm.
have more a higher interest expense in dollars, and so this is going to be a lot bigger delta in how much of your excess um, cash at the month can go into discretionary spending, and it's going to be a substantial curtailment because of that higher interest expense. So that's what's new this year. And then we talked a little bit about how prices. So this is CPI, and consumers are very focused on price points. So this is CPI for BevAlc, and I'm looking at between on-prem and off-prem, and off-prem has been more mild. On-prem, as we came and bounced out of the pandemic, was really quite substantial, and consumers are going to notice that. They're going to want the cocktail price that they had here, not the one that was here. And then if we look at liquor stores, this is an interesting one. This is looking at the prices that they're charging consumers versus what they're paying their wholesalers for the product. And you can see really this year, at the beginning of this year, that there's a pretty big downward trend
Mm.
in wholesalers, giving discounts and cutting prices to retailers to, carry their inventory. And as we know, wholesalers had too much inventory. Retailers are too much inventory, but they're still being, they're being paid to actually hold that inventory. And, this is going to be pretty significant in terms of the category, which we'll talk about in a minute. I've talked about this one before. This is just looking over the overall spirits category, 19 versus 23. 8.2% annualized growth in sales. A lot of that was mix, right? So this is higher price points. I mean, some was inflation, but a lot of this was consumers trading up into higher quality liquids. The industry's talked about ad nauseum, and that's something to be thoughtful of. And because what we're seeing really across consumer categories is that mix is no longer driving growth. In fact, we're seeing consumers trade down in terms of that mix. And I'm just using yoga as a category here. There's a lot of parallels because yoga was highly mix driven. And this is visits to Lululemon, Athleta, Viore, and Elo Yoga, and then just really strong growth. And then you can see visits to the category have just stalled out really when we hit January. So if we look at restaurant land, so full service restaurants is FSR. And so restaurant lands now, we're seeing a lot of big smash promotions, loud promotions, both in full serve and in quick serve, and that's, intended to drive visitations and consideration. And it's going to be leading to also lower check amounts, because it's value that's being promoted, because value is moving the consumer these days. And so as Chili's launches their smash burger promotion, you can see a pretty significant step up in visits. So when we think about the full service category, it's like, what is your menu plan? What is your value plan in terms of, which operator, which brand is going to be able to draw growth versus, brands that are going to be seeing a decline or market share loss. The same thing at Buffalo Wild Wings, big increases in visits when they do these promotions. And this is broad across the industry, because for the brand that sees a lift, there's a deficit that happens to another one. Another big change this year within restaurants, which I think has ripple-on effects to this is looking at the California increased minimum wage for QSR to $20 per hour. But non-QSR restaurants are going to feel that, and retailers are going to have to match that. But also as a consequence of those higher wage rates, operators increased their prices on their menu in QSR, and California went from an outperforming region to an underperforming region in QSR because of those higher menu prices. This is looking at another dynamic is curiously that when prices went up, it really affected the QSR across the different categories. But curiously, because the value of those fast food meals eroded so much, that some of the consequences was that consumers moved into value full service restaurants. So Olive Gardens and Chili's seeing a benefit in traffic, because people say, if I'm going to spend, whatever the number is, $20 on a Happy Meal, I might as well have a Happy Meal at Olive Gardens. And by the way, I can pair that up with a cocktail or whatnot. Talking a little bit about the wholesale category and the spirits category. There's a few items here. This is a really noisy chart. That's by intention, because I think part of the problem and confusion is that there's so many levels of unprecedented that are lapping upon themselves, that and compounding, that's really hard to understand what exactly is going on. 22 really 23 22 was coming out of a pandemic. 23 24 was really severe inflation and quantitative tightening. Then we have a kind of this essentials services and inflation in interest expense and in insurance, and all of this is just layering upon layering. So it becomes things very confusing. And then, these hard discounts and promotions this year, I think, is creating, another level of distortions. And I'm showing you, I'm a customer of Albertsons. These are the deals plus that I've seen that I just took snips from my phone. $26 for a liter and a 1.75 liter Tanqueray. And I didn't have it. They actually I didn't save it, but I saw one promotion was $22 for 175 of Bombay Sapphire with a limit of 6, kind of, which I show here on the right hand side. With I was able to buy 6 bottles. I have enough gin now in my liquor cabinet at home to last me for 6 months to a year. So as we kind of move later in this year, this whole home liquor cabinet dynamic and these levels of promotion, it's going to be interesting to see what happens in terms of the overall spirits category
Right.
consumer spend, because we might have pulled forward a lot of demand. This is looking California slower in July, both for BevMo and Total Wine. I strongly suspect that a lot of reasons for slower results in June and July, or July really, is these promotions at Albertsons and Safeway on branded, popular branded spirits. And then if I look at BevMo within 3 big markets, we can see that, Los Angeles pretty stable for BevMo. San Francisco down in July, and San Diego down in July as well. So there's and BevMo, is a an interesting business because it's been going through changes, but it's still a very large retailer for the category. This is just looking at reported results by the large manufacturers. Diageo is the only one that's been out with first half of 24 numbers. So through June of this year, their communication was really, not to expect a whole lot of difference as we move into the second half. They say that retailers and distributor inventories are pretty clean. But these high promotions also are going to be dynamic. And now if I look here in the bottom right, we're down on volume versus pre-pandemic, down in volume, pretty severely on 1-year basis and a 2-year basis, but we're still up on price mix.
Hey,
So
Thomas, I have a question.
yeah,
So for this slide here, it looks to me like, shipping volumes are sort of normalizing, that the pandemic sort of heights maybe have sort of leveled out. But compared to
yeah,
your noisy chart,
yeah,
where it's so do you think then that 2024 is sort of, could you say it's a normalizing year? If 2022 and
yeah, yeah.
2023 were unprecedented, are we
It's
normalizing?
a normal, yeah, it's a normalizing year on volume. Price mix is 42%, in contrast to this one. I'm a little bit anxious.
Okay.
So, um, and then if I look,
What should make you this one actually made me anxious about then 2025, to your point about how, there was that, did we pull forward too much demand now? And if you yourself have, your own personal stock of gin for the next 6 months to a year, then are we just sort of buying trouble? Well, not we, but are we sort of buying trouble for 2025, this time 25?
yeah,
So it'll be
I mean
interesting to
that's
look at
one,
that next year.
yeah, I mean that's one thing I'm uh, pondering.
Hmm.
But I shared this slide in the last presentation I did for the folks. So this is just looking at wholesaler inventory. So this is Bev wine and spirits. So it's I understand for this industry that there's the spirits and wine are different than beer, but this is how the data is presented by the Census Bureau. And if I assume that sell through from the wholesalers to retailers is like 2%, year on year going through the end of the year. And I assume that, wholesalers still want to bring down inventory levels to return to pre-pandemic levels. We're going to be destocking all the way through the end of the year, and that will be a headwind. Broadly, from a macro perspective, each brand will have different relationships with their wholesalers, but the wholesalers in total look to be in destocking mode and that kind of makes sense because you're going to try to destock into the holidays because that's the stronger seasonal period. Do I have any good news? So this is my one good news slide, which is looking at, again, grocery being a big dynamic in terms of impressions and feeling around inflation. And this is looking at grocery prices, the CPI, what the consumer pays. PPI is what the grocer is paying the manufacturers. And you can see a pretty big step down in what the grocers are paying the wholesalers. And if this continues, and I think the trends that we talked about earlier in terms of shopping multiple banners and cross shopping continue, then I think there's a good case to be made that CPI for food is going to move negative, which would be a huge release in consumer confidence and a relief for lower, the less affluent, and obviously would set a faster pace for rates, which would then lower interest rates by the Fed, which would lower interest costs, and everything kind of happens kind of happily from there. So I know we're tight on time, so I just got to
And
go.
I know, Thomas, and you already went through the takeaways at the beginning.
Yep.
So let me
Yep.
just stop and ask if anybody has any questions. I haven't seen any in the chat throughout, but let's just take a pause and see if anybody has any questions. And if you do, use the sort of raise your hand icon at the top of your screen or put a question in the chat. And then while we're waiting for questions, I don't know, Thomas, if you have anything final to wrap up, that would be great.
Okay. Yeah. I mean, I'm sorry, I should have, you told me not to do this. Let's see here. So that, I mean, just the thing, it's likely to be a very distracting presidential election. It's a reasonable period of time, September and October. It's not really the holidays. I think, generally Thanksgiving obviously going to be about 2.5 weeks after the presidential election. Hopefully everything's wrapped up by then. And, I think Thanksgiving and holidays should prevail again. Last year, the consumer and, every forecaster was predicting that we were going to go into a recession in 23 as we got into September, October. Everybody said, what everybody tells me, we're going to have a recession, so I better be careful now. And that led to a consumer pullback. And then by the time we got to Thanksgiving, people said, hey, things seem okay. And so things, really really lifted and things became festive and Thanksgiving dinners were shared and
Yeah.
celebrated and
So fingers
holidays were
crossed
good.
again. We do
And
have a
so
question that came in. Thomas, we do have a
yeah.
question that came in from the chat. Somebody was wondering what was going on with reorders from wholesalers. And he thought that actually your data confirmed it and that too much inventory is sitting. Would you agree with that?
Yeah, I mean that's not our data, but
Okay.
that's what this right here, the Census Bureau's that would be um, telling that that
Yeah.
depletions are ahead of wholesaler inventories.
Yeah. Okay. Awesome. So I don't see any more questions in the chat, and I know we're going to run short of time quickly here. So I want to thank you, Thomas, for always a very thorough and lots of data, which is super helpful. And like I said in the beginning of the webinar, for everybody, we'll send the recording, the link to the recording out to anybody who registered for this webinar. And if you do want to touch base with Thomas, we'll include his contact information not only in the email with the link, and it's also in this deck. But I want to thank everyone for joining us. But before everyone goes, I just want to say, just give you highlights of a couple of upcoming Discus webinars. Next week on August 20th, we're going to be focusing on direct-to-consumer e-commerce strategies with Speakeasy. Highlight September 3rd, applications are open for the Discus Academy Leadership Program. September 11th, we'll have a webinar with Nielsen IQ. And then September 18, we're working on a webinar with the Small Business Association. So stay tuned for all those webinar invitations. And again, Thomas, thank you.
Thank you all.
For another great presentation. And I want to thank everyone for joining us. Like again, if you have any questions or suggestions about topics that Discus could cover, please email us at membership@distilledspirits.org. And with that, I don't see any more questions. Thomas, thank you. Our webinar is now concluded, so everyone may disconnect.